Dim sum bonds. When I read this article in the Financial Times today, that was my first thought. They are not the exclusive focus of the story, but they highlight a terminology minefield that even confuses seasoned investors. What is the difference between dim sum bonds, Panda Bonds, Dragon Bonds and Eurobonds? The Chinese government expands the access of investors to the offshore bond market in Hong Kong. But let's first focus on the terminology. Here's a quick guide. We know issuing a bond means borrowing money on the capital market. A dim sum bond is denominated in Chinese yuan or RMB and issued offshore, typically in Hong Kong, by either a Chinese or a foreign institution. Offshore means outside the home market of the currency. For the RMB, the home market is mainland China. A Panda bond is also denominated in RMB, but it is issued in mainland China by a foreign issuer, which could, for example, be a US firm. Finally, a Eurobond is any bond that is issued outside the home market of the currency in which it is denominated. For example, a US dollar bond that is issued in, let's say, London or Hong Kong. As you can see, a Eurobond is just another name for an offshore bond. The term is purely historical and has nothing to do with the euro. That's why a dim sum bond is technically an RMB Eurobond. Finally, a Dragon bond is a less precise and broader term for Eurobonds that are issued in Asian markets and typically denominated in currencies like the US dollar. Therefore, dim sum bonds and Dragon bonds are specific types of Eurobonds. In contrast, Panda bonds are issued in local currency, RMB, but by a foreign issuer. These famous nicknames of bonds, however, are only a very small segment of the whole Chinese bond market, which is one of the biggest in the world. In the end, China's attempt to expand access to the Hong Kong offshore bond market is about more than just bond labels. It's about strengthening the RMB's role in the global financial system. But now you know the difference.